Good afternoon, everyone. Thank you for joining us today for our webinar, How Do I Use Family Limited Partnerships, FLPs, and Family Limited Liability Companies, FLLCs, to protect my assets and save taxes, with our host, Wayne Zell. I'm Kat Parker, Marketing Director at Zell Law, and I'll be your co-host today. There will be a few polls throughout the presentation, and your answers will be anonymous, so feel free to answer honestly. We will also have a Q&A and a brief survey at the end of the presentation. Please chat me directly if you want to receive CE credit for this hour and were unable to submit your information through the Zoom webinar registration. And now I would like to turn it over to Wayne Zell, the founder of Zell Law, an estate and business planning law firm with offices in Reston, Virginia, and Savannah, Georgia, serving clients nationwide.
Thanks, Kat. Welcome everybody to the seminar. Before I get into talking about the overview, this is the overview of the things that we're going to be talking about today. Let me tell you a little bit about what a partnership is and isn't, and what a limited liability company is and isn't, because sometimes these terms get confused. A partnership is basically a combination of two or more people who want to engage in a business or invest in assets for profit. And there are two basic kinds of partnerships that we typically talk about: general partnerships and limited partnerships. General partnership is where everybody's got a vote in what happens in the partnership, and everybody gets to participate in the liabilities of the partnership. So that can be good and that can be bad. It's good if there are losses, you can share the losses, but it's bad because if you are a partner in a general partnership, you also get to participate in all the liabilities. And if there's a problem, you get to share in that as well. So today, very few businesses are organized and very few investments are organized as general partnerships. In the old days, our parents, our grandparents used to use general partnerships all the time. Not today. A limited partnership has two or more partners. One of those partners must be a general partner with unlimited liability for partnership debts. So what we typically do with a family limited partnership is we have a general partner that is an entity, like an LLC, a limited liability company, or a corporation, or an S Corp, or a trust. Bottom line is very few circumstances arise where we have a family limited partnership with two partners where the general partner is an individual. We don't do that anymore because we want to provide absolute maximum asset protection and liability protection. Then you have limited liability companies. Limited liability companies, LLCs, really didn't come into being until 1987 in the United States. Wyoming was the first state with a limited liability company statute. Limited partnerships and limited liability companies are creatures of state law statutes. So they're created by statute. And there are certain things you have to do in order to create a limited liability company or a limited partnership. Today, we're going to talk about family limited liability companies and family limited partnerships as being sort of the same thing. There are clearly differences because, as I mentioned, with an FLP, you've got to always have a general partner. If you have an FLLC or an LLC, you don't have to have a general partner. In fact, everybody can be a voting member or not. You can have managers in an LLC, and the managers can be the ones that operate the business. So I just wanted to make sure we had an understanding of what the differences are and what the similarities are. Both entities offer limited liability to the limited partners in the LP and to the members in the LLC. And that's why people typically use these structures. And I'm going to give you some more reasons as to why you should be considering using these structures as opposed to just a corporation to operate a business, to own investments, to own real estate and operate real estate. It is the most flexible and most commonly used form of entity today. And when you put the word family in front of it, it's referring to you, your spouse, your ancestors, your descendants, your kids and grandkids, and trusts that might be established for their benefit. So today we're going to talk about 6 main topics. One is, when should you use an FLP or an FLLC? And there's a long list, and we're going to talk about each of those circumstances and why these types of entities are really beneficial. Then we're going to talk about the requirements of these entities. What do you need to do to formally establish an FLP or an FLLC? And how do you keep it alive so that it's not disregarded or it doesn't disappear later on and you lose the benefits that you wanted when you set up the entity in the first place? The third thing we're going to talk about and drill in greater detail on are the benefits of using an FLP or an FLLC. And then there are always income tax issues that come up when you're setting up an FLP or an FLLC and when you're operating it. And you've got to be careful that you understand what the issues are. You don't have to be an expert in this. That's for us to help you with. But we want to make sure that you understand that there are income tax issues that you need to be aware of and be careful of. And then there are also estate tax issues that you need to be cognizant of, and gift tax and generation skipping transfer taxes that you need to be aware of. And lastly, we're going to give you a success checklist that you can use to sort of make sure that you're doing the right thing at the right time with your FLP or your FLLC. But I think there's a poll question coming up.
Yes, we do have our first poll. I have created an FLP or FLLC for myself or a client. You are allowed to select more than one. To own and operate a business, to hold real estate and or other investments, to shift wealth out of my estate for fun, never but want to learn more about them, or to own all my assets. Feel free to select as many as you would like.
And Kat, if you'll leave that up on the screen after when the answers come in, I'm going to talk to some of the answers on this really quick.
Yeah, absolutely. All right, got a lot of people participating.
Good. It's good to have you all join us today, by the way. Wish we could see you in person. We'll work on that next.
All right, I'm going to go ahead and end this and the results.
All right, this is pretty interesting. Nobody sets up LLCs or FLPs for fun, which I kind of threw in there as a, does anybody do this for fun? It's pretty evenly spread out. Now, the one answer rather that I have in here that is kind of a getcha or a gotcha is the last one, to own all my assets. If you have set up an LLC or an FLP to own all your assets, you may be making a mistake. And the reason is, particularly with respect to the IRS doesn't like to see all of your personal assets and your business assets and your investment assets commingled together. And the reason is they view that as being sort of an incorporated pocketbook where you're just using the LLC to achieve some kind of tax avoidance motive, and you're really not using it for business or investment purposes. So I would be cautious about putting all of your assets into an LLC or an LP. Owning and operating businesses, absolutely. Done all the time. Owning real estate, absolutely. And other investments, marketable securities and other types of investments, closely held businesses, yes. Shifting wealth out of your estate, that's one of the main things we're going to talk about today. So it is a very useful technique for that, in addition to getting you the ability to protect your assets from creditors. And then a lot of you are just joining us to learn more about them. And that's what this is about today. We're going to teach you all the ins and outs of FLPs and LLCs, at least to the extent we can cover it in an hour. Might take a whole day's seminar really to drill into all the details. Okay, so we can close that up. All right. So this is a long laundry list of the times or the considerations that you should make when you're setting up an FLP or an FLC. This is why you should use it. The first item on the list, to reduce the value of your estate for transfer tax, estate tax, gift tax, generation skipping transfer tax, is one of the most popular reasons for using these vehicles. And because the control of the entity In an FLP is centered in a general partner. In an LLC, it may be centered in a manager who runs the LLC for the benefit of the members. By doing that, you create an immediate decrease in the value of the limited partner or the member's interest who's not the manager. How do you do that? Because they don't have control. The lack of control and also the lack of marketability of an LLC or an LP interest creates a double discount. And that discount, when you add up all the interests, it may not add up to 100%. I was explaining this to a client last night. We were, talking about, well, how do you get a discount on something and it still doesn't add up to 100%? And the answer is because the tax law lets you, and we're allowed to actually transfer an interest in an LLC for less than its percentage value of all of the assets in the LLC or the limited partnership. Let me show you how this works. Let's say we've got an exemption today from the federal estate tax of $24 million for a married couple, which is what it is today. It's going to drop by half at the end of 2025. But for the next several years, it's $24.12 million for a married couple or $12.06 million for an individual. And so if you got a discount of 30% on the interest that you're transferring to a trust or for the benefit of somebody in the family, that means you could transfer as much as $34.45 million and still take advantage of your $24 million exemption and not pay gift tax. How do I get that? I take the $24 million number and I divide it by 70%, which is 1 minus the discount. And that tells me how much in assets I can actually transfer without triggering gift tax or estate tax. That's pretty amazing, isn't it? And if the discount's higher, let's say it's 35%, based on today's exemption, you can transfer almost $37 million of assets in value using a limited partnership or an LLC interest. So that's hugely valuable. And that's one of the main reasons why we do this. Now, caution. Back in 2016, in the Obama administration, the Treasury Department enacted proposed regulations that would eliminate the ability to use these valuation discounts where you're transferring it within a family or a trust for the benefit of a family member or an LLC interest for the benefit of a family member or a trust for a family member. So they were going to throw out the ability to use valuation discounts. Those proposed regulations were put on moratorium in the Trump administration, and they were actually rescinded. They got rid of the regulations. They threw them out, which allows us to continue to use valuation discounts in the context of family limited partnerships and family LLCs. So it's still valid. What could happen? The Biden administration in the Treasury Department could do the same thing that the Obama administration did in 2016 and enact regulations that prohibit the use of valuation discounts. If they do that, it will be prospective only. So we still, even if they do it tomorrow, which there's no indication that they will, but if they do, there's a window of time that we'll have to continue to do these types of transactions, okay? So valuation discounts and reducing the value is a really valid benefit of doing this. Shifting the income tax burden, and we're going to talk about that when it comes to income tax issues in greater detail, is another benefit of using an FLP or an FLLC. And the benefit of shifting to assets to kids can be significant unless they're under the age of 19 or under the age of 24 if they're still in school full-time and they're still a full-time dependent of yours. That's where the kiddie tax comes in and limits the benefit of shifting income to lower income tax individuals, because if the kiddie tax applies, they have to pay tax at the same rate that the parents pay tax at, which could be as high as 37% on the federal level. But that is a good reason, particularly as your children mature and become more capable of owning assets. They can own it through the LLC and you can stay in control. So we're going to talk about that in a second. How do you conduct a family business? Well, you could conduct it in an LP, limited partnership. You could do it in an LLC. You could do it as a corporation, or you could do it as a sole proprietorship. But in my view, doing it as a corporation has some tax problems associated with it that wouldn't exist if it were conducted in a family limited partnership or a family LLC. For example, a subchapter C corporation, which is a regular corporation, is subject to certain penalty taxes known as the personal holding company tax and also the accumulated earnings tax. And you can be penalized if you pay unreasonable compensation to the owners. So that is a word for the wise to watch out for C corporations. Now, C corporations are taxed at lower rates today, which makes them more beneficial. And a lot of people have been, a lot of accountants particularly, have been advising clients to maybe shift over to a C corporation structure. There are benefits and detriments of that. We're going to cover that in a later seminar. But FLPs and FLLCs give you more flexibility than a C corporation would. And also, if you did it as if you set up the business as an S corporation, which was extremely popular and has been extremely popular over the years, you have to be careful because there are restrictions on who can own an S corp. For example, a non-resident alien is not allowed to own an S corp. And there are limitations on the number of shareholders, 100, that can own an S corporation. And there are other restrictions and it's a less flexible structure than an LLP or LC. So the LP and the LLC taxed as a partnership offer more flexibility in terms of conducting the business than a corporation. And a sole proprietorship, well, that could be disastrous because if you're operating a business as a sole proprietorship, that means you have no liability protection. And so you want to be very careful about doing that. Another reason to use an FLP, family limited partnership, or a family limited liability company is to maintain control. The parent who creates this entity may want to maintain control over assets that would be transferred to younger generations while they're living, but they can restrict the kids' control over these assets by shifting limited partnership interests or LLC interests and not giving them any control over the management of the entity. In a corporation, you typically have to own more than 50%. In a family limited partnership or an LLC, you can own as little as 0.1% or 1% of the entity and still have total control over all the management decisions that have to be made for the entity. So that's another reason to use an FLP or an FLLC. Protecting assets from creditors of the partners and the members is a really important consideration. Let's say you've got a senior family member who's in a high-risk profession like practicing law or being a doctor or an engineer or a builder, where lawsuits are pretty commonplace today, and they get sued for malpractice or negligence. Using an FLP or an FLLC is going to help you shield your personal assets by putting them into an entity that might be controlled by other family members, and therefore it'll be out of reach of the senior family members' creditors or predators in the future. A judgment creditor of an FLP, a person who gets a judgment against the member or the partner of the entity, only has what's called the remedy of a charging order. So they could step into the shoes of the member of the LLC or the partner of the FLP, but only to the extent that that person has control. So you'll draft an operating agreement for an LLC, or you'll draft a partnership agreement for the limited partnership that says, hey, look, if I ever go into bankruptcy, or if there's ever a claim made against me and they try to attach my partnership interest, I will cease to be the manager of the LLC. I will cease to be the controlling partner of the general partner, and I will no longer be in control of the entity. And so therefore, all they can get is whatever is distributed to me from the entity. And so you just don't make distributions from the entity, which is another reason not to put all your assets in that basket, because if there is a creditor that comes after you, they'll be able to get any distributions that are made to you from the entity. So you want to be careful about that, but it definitely provides extreme limited liability protection, both in the case of creditors as well as in the case of divorce. Keeping assets in the family unit is another really important consideration as to why we like using family limited partnerships and FLLCs. If you include, let's say, a right of first refusal in your limited partnership agreement or in your LLC operating agreement, that allows you to restrict the ability of one of your kids or one of the members or partners in the entity from transferring the interest outside the family. So the right of first refusal gives all the rest of the partners the ability to purchase the other partner's interest or member's interest if they want to get rid of their interest or they want to liquidate their value in the entity. So the right of first refusal says, if you have an offer from a third party, we get to buy your interest before you sell it to the third party for the same price. And by giving them the ability to sell at fair market value, that also gives some credibility and helps support it from an income tax perspective later on. But it allows you to keep the assets in the family unit. And that's the reason why we use rights of first refusal, or we'll have the entity have the right to buy out a member who wants to liquidate their interest, to give them fair market value if it's possible to do so without them transferring their interest outside the family unit. It also provides significant flexibility in how we manage our property. So let's say I've got a parent who wants to make a gift of property to the kids. And let's say it's a piece of real estate. And the real estate, if we transferred the property to them directly, and let's say I have 3 kids, I would transfer a tenancy in common interest to each of my 3 kids. Well, how do we manage that property absent a limited partnership or LLC agreement? And how do we protect it from a divorce action for one of the kids or a creditor where one of the kids might get into financial problems? You can avoid this problem by putting the asset into a limited partnership or an LLC and only allowing the kids to control the asset after you're gone. So you might keep a small percentage, a 1% interest in the entity, and you might be the manager of the LLC or the general partner, or you might set up an entity that you control that's the general partner to give you full limited liability protection in an LP. And in that way, the partnership's assets are beyond the reach of any creditor. So instead of owning the asset directly, either as a fee simple asset where you own 100% or a tenant in common interest where you own it with your siblings, you've got it in an entity that the creditor can't pierce into or pierce through as long as you've operated it properly. So it allows you flexibility to continue managing the property for the benefit of yourself and the family and not give up control. It also simplifies the ownership of assets. What do I mean by that? Well, let's say I set up a family limited partnership or an LLC, and I want to consolidate lots of different properties into that holding company structure. We refer to this as a family bank or a family holding company. And let's say I've got 5 pieces of real estate or 50 pieces of real estate, and they're all commercial or residential, and they're being rented out to other people. This gives me the ability to manage all the assets under a single holding company structure. And what we typically recommend is hold each piece of property, if it's real estate, in a separate LLC that's a subsidiary of the LLC or the limited partnership. And the reason to do that is to isolate the liabilities of each asset into a separate entity. So if somebody gets hurt on one of your properties and sues for $10 million, and your insurance on that property is not enough to cover it, they can't go after the other properties, and they can't go after the other assets that are held by the limited partnership or the LLC. So by consolidating and centralizing the ownership of the assets, you've created an easier vehicle also to transfer ownership to the kids in the future. Let's say you had 50 pieces of property, and I've got clients who easily have that much and more in terms of real estate. And let's say we've got, I want to transfer a piece of one of the properties to one of my kids today, and I want to transfer another piece to another kid, or I want to transfer pieces of all these properties to the kids. If I did that property by property, it would be a mess. There would be ownership in 50 different properties by a whole bunch of other people, and it would be decentralized. By putting it into an LP or an LLC, we centralize the ownership, and there might only be one person managing all of those properties. It simplifies the way in which things are done, and that is actually a reason to form these for tax purposes, and the IRS will respect that reason as a good business purpose. It also helps to distribute assets at death. What do I mean by that? When the parent dies, if I own 50 pieces of real estate or 5 pieces of real estate, and I bequeath it through my will or my trust to my kids, I'm creating, ownership in each of those properties in each of my kids. So again, I've got all these different properties that are held in pieces by my children. It's much easier to transfer the property, and you can do so without incurring any kind of tax liability on the distribution of an LP interest or an LLC interest that owns all these properties. And it might also own other investment assets as well. So again, it's easing the burden on the executor or the trustee of the estate at your death to make it easier to pass the property on. I've used these vehicles very frequently for family compounds or family-owned properties, farms, beach houses, where the owner wants to build something beautiful that is going to be a legacy for the children to enjoy, for the grandkids to enjoy, great grandkids. And we've got clients who are on their 4th generation of owning property in a family limited partnership or an FLLC that allows for these younger generations to continue participating and enjoying the property without actually owning a piece of the property. Somebody else manages it, or one of the family members manages it. Avoiding ancillary probate. If I own 50 properties and they're in 30 states, and I'm a resident of Virginia, let's say, I'm going to have probate in 30 other states where those properties are located if I own them in my own name at my death. That means we have to hire lawyers in the 30 different states to handle the ancillary probate of managing the property so that it goes under the terms of your will or trust to whoever it's supposed to go to. Well, we use revocable trusts or LPs or LLCs to make it easier, because if all you own is an LP interest or an LLC interest, that's viewed as what we call personal property. And the state of your residence governs how it passes. So you don't have to worry about filing for probate in all of these other states where the property may be located if it's owned by an LP or an LLC. So again, this simplifies things significantly. And the last reason I like to cite for using an FLP or an FLLC, I like the picture, is to discourage family fights and encourage harmony. Unlike a trust, an FLP agreement or an LLC operating agreement may require that the members or the partners enter into binding arbitration if there's a dispute relating to the partnership assets and how they're managing, or the LLC assets and how they're being managed. And so it can be drafted also to take account of an embittered partner. One of the family members wants to disrupt the way the parents set this up and sue to force a judicial liquidation of the entity. Well, if the court finds against the disruptive family member, you can put a provision in the limited partnership agreement or the operating agreement for the LLC that says, if you lose, you pay. You pay for the court costs, you pay for the fees, You pay for the attorney's costs of everybody who's brought into this lawsuit, including the LLC or the partnership itself. So that's just smart drafting, and it also encourages good behavior by all the members of the partnership.
All right, we do have a poll, Wayne.
Go for it.
So I'm going to go ahead and launch it. Why use a FLP instead of a FLLC? Please choose the best answer. FLPs have been around longer and have more developed law. FLPs are easier to set up. FLPs give greater asset protection. FLPs work better in certain states, for example, Texas. Or FLPs are easier to understand and more flexible than FLLCs.
There's some trick questions in here, so be careful.
All right, about half of you answered so far.
Give it a couple more seconds.
Okay. And the results.
FLPs have been around longer and have been more developed law. Only 1 in 10 of you who answered the poll said that that is a good reason. Actually, it is a good reason. That would be a reason to use an FLP over an FLLC, because FLLCs have only been around since 1987 and Virginia since 1995 and other states even more recent than that. But FLPs are not easier to set up than FLLCs, believe me. You have to set up a general partner, usually a separate entity, plus you have to set up the limited partnership agreement. So it's not easier to set up. FLPs give greater asset protection. Not true. Actually, if you put an individual in a FLP as the general partner, they offer less asset protection because the individual general partner will be subject to liability as the general partner. So that's why we use entities to own the general partnership interest, but they don't give it greater asset protection than FLLCs with 2 or more members. An FLP works better in certain states. That is true. In Texas, particularly, you'll see FLPs being used mainly because of the oil and gas industry. It's historically been used, and there's very strongly developed laws that relate to FLPs. And because Texas is a community property state, there are community property rules that work well with LPs better than LLCs. So that's why we use LPs in Texas, but not most every other state. We use LLCs. Florida, Virginia, Maryland, DC, Delaware, we use LLCs. And lastly, FLPs are easier to understand and more flexible than FLLCs. Not true. Actually, LLCs are the most flexible entity that you could imagine. And because of the way the statutes are written in certain states, like Virginia and Delaware, the statutes are very flexible and give us the opportunity to do a lot of great stuff. So the next segment we're going to talk about real quickly are the requirements. This is really important. A lot of people think, I'll go to LegalZoom, I'll set up my FLP, usually FLLC, a limited liability company, and go from there. And I don't have to worry about anything. And it is easy to set up an LLC. An LLC only requires articles of organization or a certificate of formation, depending on the state you're in. And that might only be 2 or 3 paragraphs long. And it's clearly less than a page. And in most cases, in many states, you can just go online. Like in Virginia, you can set up an LLC in 10 minutes. I mean, it's very quick. The devil's in the details, though. And in a limited partnership, you have to file a certificate of limited partnership, which is a little more detailed than the LLC requirement. But the LP agreement, the limited partnership agreement, and the operating agreement, where all the details regarding how this thing's going to operate, like the arbitration provisions that I was just talking about, that's probably the most important piece of this. And it tells you what you can and can't do, how it's governed, how interests can be transferred or not transferred to other people, how profits and losses are allocated, how capital is to be contributed to the entity. All that's governed in a written agreement. And that's really important. The state filing is easy. usually very easy to accomplish. You also typically want to get an employer ID number from the IRS, which you can do online. We do that for our clients. And you have to file Form SS4 to back up the online filing. Very easy to do for a limited liability company or a FLP taxed as a partnership. One of the things that people forget, though, is, okay, we've set up the entity. Now we've got to get the assets in the entity, and we have to do it first before we transfer any interest to any third party or any trust or any child. And the reason is we don't want any attacks by the IRS, and we want to make sure that we have put the right assets in at the beginning so that we can then transfer the interest and get a good valuation discount on what we've put into the LLC. So transferring title, doing deeds for real estate, transferring marketable securities into a new account at your brokerage firm, actually transferring stock in your closely held company into the LLC. Opening accounts, you definitely want to have bank accounts and securities accounts established in the name of the entity. And you also want to have a separate accounting ledger for it. Some people use QuickBooks, some people use more sophisticated systems, other people use Excel, but it doesn't matter as long as you've kept separate books and records for the entity, which gives it more credence, more credibility if a creditor ever comes knocking and tries to attack the LLC and go through the LLC to get to the LLC's assets or the partnership assets. You also want to make sure that any contract you enter into, including leases with your tenants, any contract with vendors or customers, are signed in the name of the entity. So an LLC might be signed by the manager or by the managing member. The limited partnership might be signed by the general partner, which might be an entity, which also has to be signed by the president of the entity or the manager of the LLC. It's a little more sophisticated, a little more complicated, but you want to make sure your contracts reflect that structure. When we were talking earlier about putting all your assets into the LLC or the LP, this is why you want to avoid it. If you commingle your personal assets with the assets of the entity, and there are other members who are also doing the same thing, we have created a vehicle that some tax practitioners refer to as an incorporated pocketbook, which is deadly. It may lead the IRS to completely collapse the entity and bring back the interest that you've transferred out to your kids or a trust for their benefit back into your estate. So one of the pieces of guidance I always give our clients is put investment assets in the LLC, put business assets in the LLC, but don't put all your personal residences and all your personal assets in the LLC. You can put a vacation home in there or your second or third residence in there, but don't put all your personal assets in there. File annual reports with the state. Virginia requires an annual report. It's really simple. Other states do the same. And file income tax returns. A partnership or an LLC taxed as a partnership doesn't pay tax typically in any jurisdiction except for a couple, like DC. DC taxes the profits of a partnership or an LLC under its unincorporated business franchise tax, which is kind of a hidden corporate tax that it imposes on partnerships and LLCs, which is why I try to steer my clients away from doing stuff in DC, except maybe owning real estate. But filing a partnership return simply means that you're reporting the income and you're giving a K1, which is a schedule attached to the partnership return, to each of the members to report their share of profits and losses. And then, of course, you want to pay your annual filing fees. If you do all this stuff and you do it religiously every year, you're going to have a valid entity that will sustain any kind of challenge from the government or from creditors who are arguing that this is some kind of sham. Next, we're going to talk about the benefits of using an LLC or an LP. As I mentioned earlier, controlling your assets through the entity can be accomplished if you use an LP or an LLC. And even if you only retain a small or minimal interest in the entity. And in some cases, you can actually, in an LLC, you can actually control the LLC without owning anything. And so the question is the IRS going to respect this both for estate planning purposes or for income tax purposes? And we'll get into that in a second, but it provides you with the ability to manage and control assets. Now, who should be the manager of an LLC? Who should be the general partner or control the general partner of a limited partnership? It's somebody who knows how to manage and invest the assets. It's somebody who can make decisions on distributions of the partnership income and assets. Here, you have to be careful if you set up an estate planning structure where you're trying to transfer assets out of your estate. And if you maintain absolute control over all distributions and liquidating the entity, the IRS may use that to bring the asset back into your estate, the limited partnership interest or the LLC interest back into your estate. So involving a third party, who usually is an independent third party, is advisable under those circumstances. But you want to make sure whoever's running this is filing all the income tax returns, filing the annual reports, giving the partners their K-1s to let them know what their share of partnership losses and income are, and making sure that all of this stuff is being done religiously in the name of the entity, not in any one individual's entity. And then again, ensuring family ownership is also a really important thing to do. So I mentioned a right of first refusal, where you give all the remaining partners the right to buy out somebody's interest if they want to leave. You just want to make sure it's done at fair market value so it doesn't create an income tax problem for the partnership. Reducing transfer taxes. Clearly one of the most important techniques. I mentioned earlier the idea of I could put $37 million of assets into this entity, transfer 99% of that 37 million to a trust for the benefit of my spouse and my kids, and just do it by a gift and not be subject to gift tax. You're thinking, how did you do that again? I got a discount, and the discount may have been 35% to get me up to the $37 million number. How did I calculate it? 24 million divided by 1 minus 65%, 1 minus 35%, which is 65%. So you take 24 million divided by 65%, you get about $36.92 million, close to $37 million. You can transfer that out of your estate without any kind of income tax, gift tax, or estate tax, and you've shifted that all to future generations. The value of that discount is worth 40%, because that is the tax rate that's imposed on gifts or estates over the exemption. So if the valuation discount is upheld and the IRS doesn't challenge it, 37 million minus 24 million is $13 million. And if you multiply that times 40%, that's $5.2 million of immediate tax savings that you've generated for your family by structuring it this way. And any appreciation on those assets, on that 99% interest that you transferred to a trust or to your kids, is forever outside of your estate. So if the assets grow from 37 million to 137 million, you've just sheltered another $100 million of assets at a 40% tax savings. Think about it. It's huge. And so related to that is being able to secure a valuation discount. Again, watch out for regulations that could be proposed during the Biden administration's tenure, and we're going to keep our eyes open for that as well. And lastly, protecting the assets from creditors. I've mentioned that multiple times. The most that a creditor can get in most every state, not all states, but most every state, including Virginia, Delaware, Nevada, Wyoming, great states to set up LPs and LLCs. The most that a creditor can get is something called a charging order. Florida is another state that has that. And so if they get a charging order, all that entitles them to is to be able to step into the shoes of the partner against whom the judgment was obtained. And so the creditor steps into the shoes of a partner who has no control over the partnership or the LLC. And we would make sure that it reads that way in the operating agreement and in the partnership agreement so that the creditor can't do anything more than wait for a distribution. So what does that do? It causes creditors who are in that position to start to negotiate with the debtor partner about settling the claim. And usually it's settled for a fraction of what the debt really is, because the creditors don't want to wait 20 years or 30 years before they can get a distribution. Another reason not to put all your assets into that single basket. Okay. All right. So these are the benefits. Let's talk about now about the income tax issues. It's a little bit complex. Income taxes, estate taxes, gift taxes are always complex. But what you fear here is the application of what we call the family partnership rules. And those family partnership rules basically prevent you from taking your assets, forming a partnership or an LLC taxed as a partnership, and trying to artificially shift or split the income with your kids or other family members. And the reason that this exists is particularly relating to, think about it, service partnerships. I'm rendering services. I set up a business where I transfer a piece of the interest to my kids, but the kids aren't involved in providing any services whatsoever. The IRS looks at that with a jaundiced eye, meaning that they're going to say, wait a second, any income that you're trying to reallocate to your kids is going to be allocated back to you. And one of the key factors here is the second one that says, can I, the donor of the interest, the parent, limit the ability of the donee, the kid, to transfer their interest without suffering financial detriment? In English, that's been interpreted by the courts to mean you can't stop the kid from having the right to sell their interest for fair market value. Let me repeat that. You have to allow your child or the trust that owns this to have the ability to sell the interest in the LLC or the family limited partnership for fair market value. And what that means is, okay, I have a buyer out there who wants to buy my 10% interest. What you do is make sure that your limited partnership agreement and your operating agreement, if it's an LLC, has the right of first refusal to prevent outsiders from coming into the family partnership so that the rest of the partners can get together and buy out the departing partner. And one of the things you may want to do is buy them out using an unsecured promissory note payable to them over a long period of time with the lowest possible interest rate that you can generate. And if you do that, the question is that enforceable, and will that be upheld by a court to avoid the implication of these family partnership rules so that it stops you from shifting income to the kids? And the answer is yeah, the court cases basically stand behind us. There's a lot of other details in here. Have you ever made distributions to the donee partner? Well, if you have, that's good. If you haven't, and you're only making it to the donor partner, that's bad, and you're not going to be able to shift the income. Who's controlling the assets? Is it the donor partner? And is it normal under ordinary business circumstances to let the donor partner, the parent, control all these assets? All of these things are factors that come into play when you're dealing with these income tax rules. If the donee is treated as the owner of the income, the kid, or the trust for the benefit of the kid or the family, then all the income, all the expenses, all the losses and gains can pass through to the donee, and they may be able to pay tax at a lower rate. Also, they'll get the benefit of what we call a basis step up on the assets for any interest that's transferred to them at death from the parent. So there's a code section that allows the basis of the partnership assets to actually get stepped up to fair market value just as you would receive a stepped up basis in the interest that's being passed to you, which allows you to depreciate, claim amortization. It allows you to get greater deductions. It's a valuable election that can be made. You can withdraw assets from the partnership without generating gain in many cases. And again, you can shift the income to the family members. So that is a reason to make sure that you follow these rules carefully. I think I mentioned a couple of these, but you just want to make sure if you make a gift, and this is the last bullet with the sub bullets underneath it. If you make a gift of an LP interest or an LLC interest to a family member, or you sell it to them in exchange for some type of long-term note, you still should report it to the IRS on a gift tax return on Form 709. That starts the running of the statute of limitations, where the IRS has 3 years from the time you file the tax return to audit you and question valuation, structure, the assumptions that you used. And if they don't audit you in that time frame, you've escaped any kind of challenge that could be posed much later on if a tax return is not filed. And you also want to make sure that you get appraisals on the assets that are inside the partnership or LLC, and also on the LP interest itself or the LLC interest itself, which generates the discount. You should never just assume that the discount is 30 or 35%. You always want to hire an appraiser. It's worth it to do so, to pay the appraiser to get a report that gets attached to the gift tax return.
All right, Wayne, we do have another poll. Which of the following benefits do you want to achieve in your FLP FLLC? Keep management control over the LP LLC assets, ensure continued family ownership of the assets, reduce gift and estate taxes, or protect assets from creditors and predators. All right, got about half of you guys already. Thank you for participating. All right, and the results.
Interesting. The most prevalent desire is to ensure continued family ownership of the assets, which is a very good rationale. But all of these ideas, all of these benefits are important, and it's good to see that most everybody believes that as well. So we have talked about estate tax planning and gift tax planning. Transferring an LP interest or an LLC interest is a really valuable tool, not only to freeze the value of what you have in your estate and what you're giving to them today, but it also shifts wealth out of your estate in the form of the discount, as well as any future appreciation. The most important thing you have to remember is that you don't want the IRS to assert that this is a sham of some kind and cause the LP interest that you transferred to be brought back into your estate at your death because of some defect in the way you've structured things. So one of the things that we like to make sure of is the manager of the LLC, which might be the parent, or the general partner, which might be controlled by the parent, needs to relinquish certain rights to a third party, as I mentioned earlier. The right to control distributions and liquidation of the entity should be held by a third party other than them, the parent, or a child. It might be an independent third party who steps in as an independent trustee or an independent special manager who has that vote. And then we want to make sure that the distributions are being made according to the way in which the capital is contributed or deemed contributed by the donee. So we want to make sure that the allocation of profits and losses are being done according to the capital accounts. And we want valid non-tax business purposes like centralizing management of decentralized assets. Keeping assets in the family is a non-tax purpose. And then making sure that we've satisfied some of the other limitations and requirements that are imposed under the Internal Revenue Code to prevent the IRS from dragging these assets back in. And that's a structuring question that you leave to your estate planning attorney. So here's a success list, a checklist that I've pulled together, and we'll give this to you in hard copy if you need it. We'll print it out. Just let us know, send us an email and we'll send it to you. But the main, I guess top dozen items are, did we document in our operating agreement or in our LP agreement the non-tax reasons for setting this up? Like centralized management, like keeping family assets in the family, like keeping management and control within a certain limited group of people. Did we get an appraisal that from a qualified appraiser, not just the CPA who does our tax returns, but somebody who's actually a certified valuation expert? Did we avoid commingling our funds, our personal funds, with the business assets? In other words, do we have assets outside of the limited partnership that we can live on, and the LLC that we can live on, which is an important consideration? Did we change the management and structure of how we manage the assets other than a mere change in name? In other words, did we create a new entity that has its own governance rules that requires participation of people other than the parent who was controlling 100% of things before? That is where we get into that independent manager who might be involved in distributions and liquidation. Did we do this in the right time frame and in the right sequence? In other words, did we put assets in the limited liability company or LP first, and then we transfer the interest? That's the right way to do it. Did the donor, the parent, have assets outside the LP or LLC? I already mentioned that one, but that's a really important one. Did we do this before the donor, before the parent was on his or her deathbed? In other words, there are court cases that deal with the deathbed transfers, and everybody knows that that was done at the last minute for no real reason other than to get some kind of valuation discount and utilize an exemption before it was too late. Did we put only business and investment assets in the LLC? In other words, did we do what I said at the beginning and not put all your assets in this entity? Are the general partners and the managers actively involved in the management of the business? And can a donor be removed as a general partner or a manager? My clients don't like that. They don't like that, to have the ability to be removed. So that may be one factor that we have to relinquish and give up on, because the parent may not want to be removed by their kids under any circumstance whatsoever, unless they're dead and then they're no longer serving, or they're incapacitated permanently. And we talked about the right to determine when and how distributions are to be made and when liquidation occur. We want a third party other than the donor involved in making that determination. And lastly, are we meeting the formalities of what the partnership agreement or the operating agreement says and what state law may require? And what creditors are looking for is, are you operating this like a business? Are you operating it like an investment vehicle? Those are the success checklist factors.
All right, Wayne, we do have one last poll. Would you like to learn more about FLPs and FLLCs? Yes, please contact me to set up an appointment. If you do want to do that, please chat me in the box and I will give you my email so you can shoot that over. We can send you some more info. Yes, but I will contact you, or no, I am not interested in learning more.
We hope you are interested in learning more, and we're always available to answer your questions. If you're an existing client, we'll always talk to you. And you can just send me an email and we'll schedule you for a consultation. If you're not an existing client or you have people that you want to refer to us, we'd be honored to accept your referrals of those clients or referrals. And, frankly, that's how we've grown our business, is by you all helping us do what we need to do. And we can help you accomplish what your goals and objectives are. So many of you will contact us. That's great. We'd love to hear from you. Those who do want us to contact them directly, as I've already shared that with the host. And without further ado, I am grateful, very grateful for all of you participating today. For those that missed it, we'll follow up and find out if we can share it with you in a different way. And for those that didn't know about it, tell your friends, tell your colleagues about it, because it helps us accomplish our objective of helping you realize your personal dreams of wealth and freedom. Thank you so much for listening to this Lunch and Learn today. And again, have a great rest of the week, and we'll see you soon.